Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Pierre, senior mentor and manager.
Yes, sir.
Yes, you are.
Welcome. Thanks for having me.
Thank you. Thank you. We've talked a ton about S-Corps throughout this podcast, so much that I almost feel like I understand them.
All right. So you're teaching this?
But don't ask me anything about it. They are them and C-Corps. They fall into this this weird realm that, you can take money out, you can put money in, weigh your deductions. It doesn't seem as straightforward as opposed to a simple LLC. Okay. So let's really kind of get into it. There's this, because I understand there's this wealth trap.
Yes.
Right. Because S Corps are typically bigger. Yep. They're bigger than your normal LLC. Yep. So let's get into that wealth trap.
So obviously the wealth trap, what we're talking about is every year, most S Corp owners, all they focus on is trying to get their taxable income down to zero. And that you may be missing some opportunity if that's what you do every year.
But doesn't that sound like a good thing?
Yeah.
Right? Hey, zero, I didn't get taxed.
Yes and no. Yep. So what we're talking about here is sometimes paying a little S Corp tax can make you richer.
You're going to have to really explain that one.
All right. So I'll go through an example with you here. If you have an S corporation and you take $100,000 in wages out, and you take $100,000 in revenue over 10 years, right? Take your shoes off. The math is $2 million of income, right? $1 million, million in wages, million in wages, billion. We know you got 10 shoes in hands, million in wages, billion in revenue. Okay. So let's just say, and I know there's a lot of other things involved here, but this is the concept. $1 million in wages over 10 years, right? If you take 100,000 each year and 100,000 in wages, your income is 200,000 each year. 200,000 at what would normally be for married filing joint an income tax bracket of 22, maybe some at 24% is, let's call it $400,000, right? $2 million times 24 is 460. I had it written down. The federal tax rate did that because some of the bracket is about $338,000. Okay. If you wipe out your income each year and pay no tax each year and pick up all that income in year 10, because you can only defer it so far. You can't buy a piece of equipment. You can't do everything every year. You get to year 10 when you're in those tax brackets and all those tax brackets get stacked up in 1 year, your tax bill will be roughly $437,000. All right. So both guys made $20 million, right? I'm not 20. Yeah. Both guys made $2 million and one paid $338 and the other one paid $437. Which one do you want to be? Okay. Now there's always more to the story. Mm-hmm. So in this theory, you'd have more for your company at the end of the year. So if you harvest the tax brackets each year, then you'd pay less tax over time. Nobody likes paying taxes except for Oliver Wendell Holmes, who said, I love paying taxes. With it, I buy civilization. So there's something there, but especially right now in the economy, people are concerned about what they're doing with the taxes. I don't need to pay taxes. I need to buy food for my family, gas for my car.
At $3.50 or whatever. Yep.
But real wealth comes from looking at the whole picture and trying to minimize your tax picture overall.
Okay. So realistically, this is more of a strategy, right? Mm-hmm. You're looking at it and saying, okay, I'm doing, I will be with my business for 10 years.
Yes.
I will own it. So, and then you say, okay, these 10 years, I'm going to do this.
Yep.
That way, when finally comes time for you to exit the business or whatever, you are not paying a gigantic amount.
Yes, part of it too. And also related to that, not only are you not paying a giant amount at the end of the year, because you've paid tax on pieces of it the whole way along. That's what you're talking about. So when we go to sell it, we don't have to pay tax on it again. We only pay tax on the value of the company. So one of the other things that S Corp owners get in a trap with, they pay themselves some salary and then they pay themselves some dividends, right? So in my scenario, $100,000 in salary, $100,000 in dividends, because that's what the company earned each year. You should be able to distribute it to do whatever else you want with that money. So there's that's why I said there's more pieces to that. I was just trying to teach the concept of why it makes sense. So you might take that $100,000 in dividends, pay your tax on it. Dividend tax rate is 20%, right? But I'm sorry, dividend tax rates for other investments is 20%. Dividend tax, there's no tax on the dividend you took out unless you don't have basis. So follow me here. First year you start the business, you put in $100,000 of equity to buy your Pizza Hut or your auto shop. That $100,000 is your investment in there. Year one comes along and you make $100,000. Your investment is now $200,000 because you had $100,000 of earnings and $100,000 of your original investment. All right. Then you take out $100,000 of dividends. You say, give me some of that money I earned this year. Give it back to me. Because we have bases of $200,000, we don't pay any tax, any additional tax. You paid the tax on the income and you get that money back, right? But say you took out $250,000 in year one because you found the Corvette you had to have and the house you had to have, and you took out $250,000 and the boat you had to have, and the kids needed braces on all of their teeth. You had to take that money out. That $50,000 that we took out above the $200,000, we have to pay a dividend tax on that.
That is
double taxation. That could be as much as 20% because your income is now high. So your income, which you already paid tax on, maybe 24 in our scenario, if you break it up over 10 years, now you're paying 24 plus 20% on that 50,000. That's a big number. And a lot of people think, oh, let me get my tax to zero, right? So I don't have to pay any tax, but you don't get any additional basis if you take your tax to zero. That doesn't mean don't invest in your company. A lot of times, though, we worry about the end of year tax trap. My favorite question. Pierre, can I get a van? Yeah, you can get a van. Sure. Why do you need a van, right?
Is this the equivalent to a boat?
No, because a van, so I have my electrician.
Okay.
He has to get to people's houses to fix their electrical problems. He has to go to the corporation that had the AC unit go down and their employees can't work. Okay. He needs a van to get there, or she needs a van to get there, right? But if you bought a van next year, hey, how's that van doing? Is it still getting you there on time? Are you missing meetings because the van is terrible and you can't get to your appointments and people are mad at you? People are mad at you. Yes, go get a van. If you just bought this van 2 years ago, and we took the deduction on that van because of Section 179, you think, oh, let me get another van so that I can take another Section 179, right? And you do that every 2 years. You buy a new van. You know who's making the money? The car dealer.
I knew the answer to this.
Yeah, so at the same time, don't think you shouldn't invest in your company to buy the tools you need and the equipment you need to get a quality job done. And that will bring your income down to zero, and it also makes your business better. So I'm not talking about you always need to pay tax. I'm talking about the mindset of don't buy stuff just to bring your tax down to zero.
I just want to ask, because I want some more understanding about this. What do they do with the extra vans? If they're buying a van every 2 years.
They trade it in, which causes another problem. So you trade in that van that we fully depreciated because of Section 179. You now have to recapture that income and then deduct the new van with Section 179. So you're not even getting as big a bang for your buck as you think you're getting.
And those 2 years are likely going to burn off the most profitable amounts of that vehicle's life.
Yes. Especially in business, you're going to wear it out. So vehicles are a little tough. Vans, you do get a lot of deduction on that. A car gets very little deduction. I love the rule. It's called the luxury auto limitation, and that's set at like $16,000. Show me the luxury car that you can buy for $16,000. You can buy a 30-year-old luxury car, but not too luxury.
I was talking to Henry on a different podcast about about how much devaluation has happened in his car the last 10 years.
Yes.
So he's probably down there.
So a lot of people think new car every year, new car every year. If you're going to do that, you're better off to lease the vehicle and then just pay that rent each year. But you won't get that big depreciation deduction in the first year you buy it.
Okay. What else haven't we covered with this wealth trap?
So again, the point is deferred income. Everybody thinks defer the income, defer the income, defer the income. It can cause a lot more problems than you think. And we don't want to set that up. Get out of the mindset that I need to get my tax to zero. Tax is not a 4-letter word, but people think it is. If I pay taxes, I'm doing something wrong. How does this guy not pay tax? How do people pay tax in a different way? You're paying tax. You're paying sales tax on that truck you bought. So the state loves you, but the IRS doesn't. I'll guarantee you this, the IRS doesn't care. The state does care. The IRS, they are just doing their job. So when we talk about the hidden problems of what we can see here, it's always better to pick up some income at 24% versus 37%, the highest tax bracket. Everybody can see that. Now, if you're making $1 million every year, you're not really missing the tax bracket down there. But if you're making $1 million every year, I guarantee you're taking $1 million out every year. That's the problem. If you go out with your friends on Friday night and you have $100 in your pocket, how much are you spending?
Pretty close to 100.
No, 200. Because you're going to spend the 100 and then you're going to bring that credit card out. So if you put your money other places that make money, like obviously the van for the electrician, but if you buy a machine that you can use and make money off of, that's a good investment in your company too. But if you just keep buying a car, like if you buy a new car every year, it doesn't make you any more money. It actually costs you money. But if you want to invest and expand the company, that's a different story. So I'm not saying don't keep the money in your company to get the deduction. I'm saying don't fall into the trap at the end of the year that I need to buy a new car. I mean, maybe just like cars. They're not the deduction that you think you are. And what you will be left with is the car dealer down the street loves you. You're probably getting a Valentine's Day card from them. And every time you come in the door, they smile and cheer. But we're talking about trying to build wealth for your company.
So, and just to give some examples. So let's say that electrician. So instead of buying a van every year or two, they can get some other piece of equipment, whether it's a specialized cutter or ladder, whatever, that allows them for their business to expand.
Yep.
Right. Hey, we're growing so much. Now I get 2 vans because now I have somebody else that's working. That's completely different than what we're talking about. Yeah, just buying a van just to buy a van is not a good
So exactly the point. Buy assets, not deductions. So what I mean by that, if we have a new salesperson, go get the new van so you don't have to give them a ride, drop them off, and then go pick them up to get the job done. Get the other van, all right? Because it's making more money for you. Get the machine because it's allowing you to do something that you couldn't do before that you had to send out. Get that machine. Think if you had to send your fries out to get them cooked at McDonald's versus not cooking them at your place, that's not going to work. Buy the fryer. Because that's an asset that makes you money. Don't just buy the deduction. And then, you don't need the boat unless there's some reason you need a boat in your...
Unless you do electrical in the lake.
Yeah.
Pierre, what have we missed with these S-Corps and wealth traps?
So the other thing I think you talk about long-term, at the end of the day, you want to make your company make money so that you look more valuable. When you do that,
There's
company...
a difference between looking more valuable and being more valuable.
Yeah. So most people say, I don't want to pay any tax. Oh, that's great. You feel awesome. Take that financial statement to the bank and say, hey, can you give me a loan? We're not going to give you a loan. You don't make any money. Right? I did this class up in Wisconsin where we go to high school and we ask the kids, my favorite first question, who wants to pay taxes? Nobody raises their hands. And so I said, well, that's not a good idea because paying taxes mean you made money. Right? Now you can defer, you can take all the earnings from your company and put it into machines and take all the earnings, putting it in another machine and grow your company. And maybe effectively for a number of years, your tax is zero, but you're really pushing your big payout down the road in that case too. So I don't want to confuse people and say, don't expand your business. I'm trying to hammer home, don't buy just a deduction. Don't buy the machinery Like, we don't need a machine that doesn't do taxes here. We don't need an excavator here at Kaizen CPAs. That would be fun to have. It would give us a tremendous deduction, but it wouldn't make us any money.
It would increase the morale for Pierre as he drives it around.
It would definitely increase the morale. So
excellent. Thank you so much, Pierre.
You got it.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.